So, welcome to This Cycling Life. We've got a very special episode today, actually designed very, very specifically for current and former professional cyclists. We've run a couple of webinars here on TCL talking about transitions for cyclists. What we're actually going to focus on today is a very important aspect of being a professional athlete, and that is money management. It's an area where often people are not well educated or well versed. So what we're going to try to do today is bust a few myths about how you manage your money as an athlete to set yourself up for life post the peloton. And I'm super happy today to be joined by Greg Casals. Greg is with the Blackswift group, and he's going to talk us through some of the fundamentals. But before we do that, Greg, why don't you introduce yourself and say a little bit about Blackswift Group?
Thanks, Jamie. Super excited to be here and have the opportunity to talk to both professional and former professional athletes, and especially in the area of money management. Blackswift Group is a Denver-based registered investment advisor. I'm the portfolio manager and chief investment officer for Blackswift Group, and we've been managing money for a handful of riders in the World Tour, and launched a pro cyclist fund also to help support athletes through the Pro Cyclist Foundation. But it's been a lot of fun managing money for individual investors as well as institutional investors in the space. So yeah, super happy to be here and talk to you about what we do.
Great, Greg, and thanks for making your time. And of course, you also have Tyler Hamilton working with you, who is a guy who's made that shift from being a pro rider into the world of financial advisory as well. We've had Tyler on the show. Greg, the scary thing for me, I guess, is that I've had interactions with many pro cyclists over the years, and unfortunately, many of them, do get into financial difficulties, often within 3 to 5 years of retirement. So, what has been your experience there in terms of what you've witnessed and the struggle some athletes have been through?
Yeah, I think it's difficult for professional athletes because their focus is performing in the sport that they're doing, and sometimes the idea or the thought of managing their personal money is sort of secondary. And when you're in the sport or when you're active, you kind of feel like it's going to continue on forever. And I think you have to have that mindset if you really want to compete at the top level. But what we've found is that with a little education as well as enlightenment about the business of money management and how to manage a portfolio, that people tend to take it a little more seriously. But it is hard to get people's focus sometimes on their portfolio and how important it is both to start at an early age or even at a later age in managing an investment portfolio for yourself. I mean, investing is an important thing to do. It's a way to take care of yourself in the future and instead of at the moment. And so we try to really get involved in that education process.
Yeah. But I guess, Greg, one of the things I've experienced in talking to many athletes is that, there are a lot of myths, I think, around investing. I come from Australia, and I think people in Australia are relatively well informed on education with regard to investments, but for many countries, that's not the case. I live here in Belgium, and many of my Belgian friends, when you say the word investing, they think it's kind of like gambling. I mean, what for you are some of the big myths around investing and investments?
Yeah, I think like the main ones is that it's difficult or it's hard to get started, and that the markets are maybe rigged against the individual, that maybe the professionals essentially take the individual's money, and so it's not really worth the time or the effort to do it, and that you need to have a lot of money. It's complicated, and that cash is really a safe investment, and it's really not. Like if anything is true, is that a dollar today is probably worth less than it was yesterday. So I think all those myths sort of create a barrier to people even just getting started. And again, that's probably one of the most important things I think for younger professional athletes, is to really start early and start saving a little bit of money by creating an investment portfolio.
Yeah, yeah, great, understood. I mean, I guess fundamentally, investing is all about growing your money, right? I mean, it's about taking the money you have today and then putting that or investing that in a way that it's going to be worth more in the future. But maybe you can talk to us a little bit more about how you define investing. Like what is it, and why should we do it?
Yeah, I mean, I think of investing as exactly as you said, it's a way to grow your money. And again, it can really make a big difference on when you start and how you do it. And there's a lot of different ways to do that. And I think even starting by putting a little bit of your money away into an investment account is worthwhile. I think that anything you do with your money is somewhat investing, whether it's you're investing in your education, whether you're buying a house, whether you're buying a car, whether you're buying a watch. It really can be anything that you're spending money on. And the way to think about creating an investment portfolio is trying to generate a return on that money. And some people are comfortable in real estate. Some people are comfortable in investing in their education, as you have, and some people are, comfortable buying companies or stocks and bonds. And there's many different ways to invest. And really, you should always be thinking about when you're spending your money if you're going to get a return on it or if it's going to grow.
I guess another question there, Greg, is, how important is it in terms of an athlete's peace of mind to be investing and understanding that their investments will be, growing and helping them to thrive post pro cycling career?
Jamie, that's a great question. I think one of the things that I've found working with some of the guys on the world tour right now is that knowing that their portfolio is taken care of or that their investments are growing is really just one other sort of idea or theme that they don't have to worry about in life when they're training so hard. And I really think it benefits their performance or their ability to go out on the bike day after day and put in that effort, knowing that we're watching their investment portfolio and that it's growing to a point that when they're thinking about, well, what's my next year going to be like, or am I going to get another contract, or how well am I going to do next year, or how long is my career going to last, that they have this nest egg sort of building that'll give them time to be able to make a decision about a future career, what they're going to do after cycling. So I think having an investment portfolio that is performing for you helps you perform on the bike. And I think it's a very important part of being a professional.
Yeah, I think it's interesting what I mean, one of the first points you come to there, Greg, is you say start young. And the reality for many pro cyclists is that they do start young. I mean, they may well get a pro contract as under 23 or, as neo pro, start earning some decent money. And we had Adam Hansen on the show recently, and, he was saying that in his experience, many of the guys he was in teams with really didn't understand how important it was at that early age. He was saying, look, even if you're if you're earning 150,000 euros a year or dollars a year, but you're only saving 20 or 30% and putting that into investments. And then there's another guy who's maybe only earning 70 or 80,000, but is putting maybe 40 or 50% of that away instead of spending it on the nice car or the nice watch or, the beautiful apartment in Monaco, or whatever it might be. And he really did emphasize that importance because of the relatively short duration of your career. It is important to start young. Is there anything you would add to that about that importance, that significance of keeping that in mind? Because it's nice to have a nice car, a nice watch, a nice apartment, right?
Sure. I mean, I think the most important thing is that if you start young and you're starting with relatively maybe small amounts of money as your career is progressing, it gives you experience. And the more experience I think you have in looking at different investments or even participating in different types of markets is valuable over time. Yep. And that is, I think, one of the most important things about starting young is that it gives you a long runway of understanding how the markets work, what your different choices could be in how to invest money, the different risks and the pitfalls, and where to find advice on how to invest. And starting young and with small amounts, hopefully as your career is progressing or as you get older and your career is progressing, you're working with bigger and bigger amounts of money. I think people that start kind of late, it's almost a little intimidating because if you're putting big chunks of money to work in the market, you almost become more sort of nervous about it. And if there's anything about investing that is your enemy, it's emotion.
So, Greg, I guess a lot of people listening think that we're probably talking about the superstars here. The guys who are at the top of their careers earning millions. But I guess we should communicate that this kind of stuff we're talking about is equally important for domestiques who are earning maybe 1/5 of what the top, earners are earning. Can you talk to that just for a moment?
Yeah, I think people like Sagan or Navali, I think they probably have good advice and they have a good advisor. But I think investing and having an investment portfolio, and again, starting early in your career or even late in your career for a professional cyclist, like the guy that's earning maybe 100,000 euros or 200,000 euros, it's probably more important than ever because those are the guys that post career. Maybe it's a little harder to find a position, or you're not going to be an announcer on the NBC Sports or something like that. So having that peace of mind, or at least knowing that you've built up a nest egg or a big enough portfolio to be able to take the time to make a decision of what career or the direction that you want to take, I think is more important than it is for the stars of the sport, because that can really make a difference. And the guys that we're managing money for, that's who they are. Like these are the worker guys in the peloton, and they've communicated like, Greg, this is the best thing that could happen for me, for both my training, for my family, for the kids that we're having, is to know that I have both someone telling me what I should do with my money, and that you're also growing it. And so that's been very satisfying for us to see that happen. We love it to be able to help those guys in the sport.
But you're absolutely right. I mean, my son, I have 3 kids, but my oldest is 18 years old. And, one of the first things I did when he turned 18 was to set him up with an investment account. And I've been, talking with him, and he's been doing his homework, and he's invested in some funds, and he's starting to get this appreciation also of the fact that it's not about playing the markets or trading, that he's putting his money in, but he's looking to a longer term horizon. But what I've seen actually is just the simple act of him setting up the account, doing his homework. He's really starting to get a bit passionate and excited about it, because he's already seen in the past year since he set up his account that he's doing reasonably well. Certainly much better than all his pals who just have their money in bank accounts or other, very low return investments. So, I mean, I've mentioned funds, but perhaps you can talk us through and explain some of the sort of more common, asset classes and investment types.
Sure. Yeah. I mean, there's the traditional asset classes of simply stocks.
Yeah.
And then there's bonds, and bonds are different than stocks, and that bonds pay sort of a stated return annually, quarterly, semi-annually. You can invest in private equity or private companies or venture capital. You can invest in hedge funds, which are more esoteric or complicated investments. You can invest in real estate. And there's so many different ways to invest in those different asset classes. Back to your point, you can invest in a fund of stocks, you can invest in a fund of bonds, or a fund of real estate. And
I mean, it might be worthwhile for you, Greg, because again, as I said, I started my son off with some funds, and one of the reasons for that, of course, is that a fund is a collection of companies, a collection of stocks, and therefore you do spread that risk. So maybe you can just explain to people a little bit about, because we use terminology like a fund, but for many people listening, they probably don't really understand what a fund is in practice.
Sure. Yeah. I mean, there's different types of funds. There's what's called an exchange traded fund that trades like a stock. And then there's a mutual fund, which trades more at the end of every day. And there's a way to buy both through really opening up a simple brokerage account or an investment account. And a mutual fund is really a collection of stocks, and it can be both actively managed, meaning there's a portfolio manager that's picking individual companies and names and trying to essentially beat the market. Or you can buy simply an index fund, which is just a basket of all the index. Probably one of the most popular index funds is the S&P 500. And the S&P 500 is the top 500 largest US companies in the market. And so there's all different types of ways to invest in the market. Yep. Funds are a great way because you do get that diversification and you can have someone professionally picking the particular positions, but you can buy index funds and that are passively managed as well. So that's one way to invest in companies. Or
so again, I think we can again we'll talk a little bit later about how to do that. Like you mentioned, setting up your own brokerage account, or we talk about working with an advisor. But I guess the important thing for people listening to understand is that when you do invest in some of the stuff we're talking about, for example, like a mutual fund with companies, that you really are reducing your risk quite significantly. Because if you invest in a security or like an individual company, if that one company goes bad, you have a problem. But a lot of the stuff we're talking about is actually the way they work is they bring together many, many different companies into one fund, which you can buy into. And by the very fact that that fund has many companies within it, your risk is actually spread across those companies. So, much lower risk than what many people see as buying or selling individual company stocks. I mean, it'd be good to hear from you, Greg, too. Just to explain to people, like you mentioned the S&P 500. What sort of annual return could you expect on something like that? So if 10 years ago I'd bought, I don't know, $100, €100 worth of S&P 500 stock, what would that be worth today?
Yeah, I think that's probably one of the most interesting things that people don't realize is that the stock market generates very good returns over a long time horizon. And in fact, if you look at the last 10 years, or 20 years, if you would have just invested 20 years ago, your portfolio would have generated 11% return a year annually.
Every year. Yeah.
Every year.
Yeah.
And so, if you're generating they call it the rule of 72s. So if you generate a 10% return every year, that doubles every 7 years. And investing in the index is a very easy way to really grow wealth or your investment portfolio. And when you tell people like, hey, would you be happy with a 10% return? Most people would be ecstatic with that. But all that's really doing is taking a very simple approach of just investing in the market or the index as a whole. You don't have to invest you don't have to find the next Google or the next Microsoft or the next Amazon. You really can take a conservative approach, which is a very diversified portfolio. And they say that's the one only free lunch in life is to diversify your investment portfolio. You can generate a pretty good return and really have lower risk as opposed to having to bet on one single stock or a couple different stocks to make money.
Great advice. Great advice. And I think clearly what you're saying there as well, and also I think for people listening, one of the fundamental, pieces of advice that was given to me early on in my career as a young guy, just starting, out in my career and starting to think about investing, was, I was told by my financial advisor, invest and then go to sleep for a very long time. And what he was telling me was that it's about not trying to time the market, but it was all about time in the market, to take that long-term perspective. And what you're explaining here is that if you do take that long-term perspective, then the returns are actually pretty much there, right? So can you also talk to us a little bit about that? Because I think, some people who are new to a market, like we've seen with, say, COVID over the last year, there has been a lot of volatility in the market, and that can cause people to panic, to think, oh gosh, my investments are down 10% within a couple of months, should I sell them? And, so what would you tell people about that, about this sort of longer term perspective, about volatility?
Yeah, I think like if you are taking a longer term perspective, or if you're consistently adding to your investment portfolio, you're going to catch both the lows and the highs.
Mm.
And so I think what people don't or sometimes miss is that you do get paid for risk, and especially market risk. Yes, you have to experience volatility, but I sometimes like to joke with people that, like, hey, if you gave me $100,000 and in 5 years I told you it was $200,000, you'd probably say that's great job, Greg. That's fantastic. But then if I said, well, wait a minute, let me tell you how I got there. You went from 100 to 80 to 120 to 150 back down to 130, and then you'd be like, I don't really care. I'm just happy that I got to 200. And that volatility is really what you have to somewhat stomach to generate a reasonable or a good return.
Yeah.
And so I think that's really important to have that mindset that if you're always just adding to your portfolio, that over time you're going to catch highs and lows. The market tends to go up and down. But I like to argue with people and say, like, you're either a pessimist about life or you're an optimist. If you're an optimist, right, you believe that the economy and the world will continue to grow and that the markets will get bigger and the companies will get bigger and you'll participate in that growth. If you're a pessimist, maybe you shouldn't be in the market at all. So that's how I like to look at things.
Absolutely. But I tell you what, Greg, it's not easy keeping my 18-year-old son away from looking at his portfolio every single day, you know.
Yeah.
He's looking at it go up and then it goes down, he comes running, but I think he's starting to understand how it works now. Great. Right. So maybe you could talk to us a little bit about how to start investing, right? So if we've got some riders out there, former riders, they're thinking, you know what, I've got cash in the bank, or maybe I've got investments in terms of real estate that is not really giving me a good return. So maybe I want to sell some of that and put it somewhere else. What are the methods for investing and how to get started?
Yeah, there's a couple different paths you can take. You can do it yourself. So you can simply open up a investment account through one of the many different online platforms here in the US. It's like TD Ameritrade or Schwab or Fidelity, and simply start contributing to an investment portfolio. And sometimes I recommend that if people want to take that path, just start with like the most basic investment. Buy like the S&P 500 or buy the NASDAQ 100, a fund or an exchange traded fund. To start. And then the other method is to hire an advisor. And there's really two types of advisors. There's your registered investment advisor, which is what Blackswift is. So we have a fiduciary duty to our client to really do and make the best choices for the client. You could also hire a broker or a brokerage firm like a Morgan Stanley or a Merrill Lynch or a Goldman Sachs. And they're not necessarily a fiduciary. A non-fiduciary has to just do something that's suitable for you. But they take into account your age, your your objectives, your risk tolerances, and various other components. The do-it-yourself way is free. You don't have to pay a fee, but you have to pay fees for the underlying investments, which again can be very low. And there's a lot of free, no commission type platforms out there now. Or you can hire a professional advisor, which typically charges some type of management fee for an investor.
Sure. The interesting one there, Greg, is I've obviously I've spent quite a few years in the market now and have gradually sort of started to educate myself. However, I found, especially with the banks, that you had to be very careful in terms of finding the right kind of advisor, because what I certainly found with the banks, because of a lot of the regulatory controls here in Europe, was they were very, very conservative. So, I'd walk into a bank and have a discussion with an advisor, and I would really get the sense this person is really not listening in terms of what I'm saying about my risk appetite, right? So what I continuously was experiencing was they were recommending me really safe and relatively low return kind of investment options, which is not what I wanted, because I was looking more longer term. I understood volatility. Can you talk a little bit about that?
Interesting you pick up on that. I mean, I can't tell you how many people walk in the door or new potential clients or new clients, and they say, like, my portfolio hasn't grown that much. I want to take risk, but seems like it's been relatively static or low returns. And I think the part of the problem is, and you can solve this a little bit by trying to manage it yourself, but that most financial advisors, or especially banks, they're somewhat constrained from a risk perspective. And they're kind of managing money really, I like to say, not to get fired. And so again, it comes back to emotion. Like if your portfolio experiences a drop based on just a drop in the market, you could get nervous and want to sell. Like when the market's down, it feels like everything is really going to be bad. Just think about in March when COVID and the virus first really started looking like it was going to cause some problems. The market went down, over 30% of the U.S. markets,
Yep.
and that's hard to stomach. And so I think a lot of advisors manage money not to get fired because they know if you get nervous or they lose a lot of money or experience a lot of volatility, that they may get fired because of it. And I think that's a problem with education. But I think like if the advisor hasn't spent enough time explaining like, hey, this is what markets do. This is how, like when the market's down that much, actually, we're going to be buying. That if you're not in that sort of proactive process, you're not going to be able to handle the client's emotion. And part of that is when you think about these big banks or the platforms, is they really don't have both the resources or the time to be meeting and managing and thinking about every specific client. And that's a disadvantage of going like with one of the big bank platforms.
And that's I guess an important point to explain as well. That basically the more money that you have in terms of, your your net worth, the more time you're typically going to get out of an organization like a bank. Whereas if you go and seek out a professional financial advisor, then you're typically paying for that advice, and likely to get more personalized advice, whatever your net worth, right? So that's an important point as well. The other aspect to this, I think, again, for people to understand, is certainly here in Europe, what I see is that, for example, many people do invest through a bank, but many banks have their own fund companies. So you walk into a bank and ask for financial advice, and they will offer you lots of products, but they're all products from within the bank, and they may not be the products that will give you the best returns. Can you talk a little bit about that, why they do that, and how you can address that?
Yeah, I mean, sure. There's definitely conflicts of interest in the investment management business. So you have to be very careful. Like fees can really eat into your returns. And if you think about if you're trying to generate a market return of 8 to 10%, but you're paying an advisor fee of 1 or 2%, if you're a smaller account, they're charging you a bigger fee. You're paying investment fee products. So a product could have anywhere from 1% to 2.5% management fees on it. So all of a sudden you're at 2.5%. And what you don't see are kind of the hidden fees. So the fund is paying transaction costs and all kinds of bookkeeping costs and things like that. So if all that adds up into a 10% return, all of a sudden that can knock your return down almost to mid-single digits, which again is makes a big difference over a long time horizon. It can really dampen the overall performance of the portfolio. So you really have to be careful about looking at the fees and what it really costs for you to get exposure.
Yeah, absolutely. So I guess the important thing here, and something I've certainly learned over the years, is you really need to select the person who's going to advise you if you do take on. And in my experience, having a financial advisor, I believe, is invaluable. We need to go into talking to financial advisors with this understanding and knowledge and be able to ask these kind of questions, right? In terms of, is your institution only offering products from your own bank or your own bucket of products? Are you open? Are you offering a more open platform? What kind of fees are you charging? How transparent are those fees? So these are questions that we shouldn't be afraid to ask. And certainly in some cases when I've had those conversations and I've started to realize that perhaps that relationship is not exactly the best for me, then I will move on and look for another more appropriate relationship. So I think that's also important, that people should never feel locked in or committed just because they have an account with a bank or another institution, that they necessarily have to do all of their financial activities through that one institution. And again, the independent financial advisor can be a very good route, because when you typically work with an independent financial advisor, they are not actually incentivized to push a particular product or fund or whatever it might be to you, as is the case in some institutions.
Yeah, no, I think that's very, very good advice. I mean, one of the things that you should remember is that it's your money. And I always tell our clients that it's like, it's your money. You can take it out whenever you want. And that, what's I think changed over maybe the last 10 years or so is that there has been a big push from the regulatory side to provide investors with as much sort of transparency and the ability to do due diligence on who's giving them advice in the firm. And what a lot of people don't know is that you really can, I mean, at least in the US, the regulatory system here is you can go online, you can type in the person's name and see if they've ever had any complaints against them, any issues with the firm. So there's a lot of information that out there that is available to investors that it's sometimes interesting to see that they don't know that they can do that, but you can do a lot of due diligence on the person giving you advice. And I always suggest people do that. It's an important part of the process because that person is ultimately managing your portfolio.
Absolutely. Great advice. And the other thing I've learned over the years also is to ask others. I've asked colleagues, work friends, who's advising you, what experience have you had, and that that also can be a little bit more reassuring. I guess the point we are making, however, is that, as you've alluded to, that there have been big regulatory changes over the past 5 to 10 years, and there were some, we would say in Australia, dodgy practices in the past with independent financial advisors, with banks and other institutions. However, that situation has changed quite significantly. And as an individual investor, you are much better protected today against any kind of shonky business practices than you were in the past. So, no reason to be afraid, no reason to be worried, and don't hesitate to pick up the phone, make an appointment, and reach out to a financial advisor. Have a talk and understand what your options are. The other thing, you explained, you can start with do it yourself, and then move on to more sophisticated advice. However, I started the other way around. I started with a financial advisor so that I could get to understand how things work, pick the brains of quite a few advisors, and then eventually built the confidence to start doing more of it myself. So it can also go in that direction. But great advice, Greg. So how does it normally work? So if someone, you mentioned you're already working with several World Tour riders. What was it that interested you specifically at Blackswift? I mean, obviously Tyler Hamilton coming on board, but how has your experience been up till now working with World Tour riders? Now, has there been anything kind of unique about them compared to some other pro athletes that you've worked with coming out of basketball or baseball or other sports like that?
Yeah, no, that's interesting. I mean, I originally sort of got into the business because I ran track and cross country in high school and college, and money management's a lot like sports. You know how well you're doing by just looking at the numbers, and if you're a runner, you just look at the time and you can tell how good you are or where you rank, right? And so money management's been a great outlet for me, having a competitive sort of background to sort of further my career with that sort of aspect of life. And I think I see that in professional athletes, like they want to do really well, and how well their portfolio is doing is very exciting to them. And that's one of the things I think that just carries over from that type of personality. If you're really performing and competing at that high level, it kind of pervades your whole life, including your investment portfolio. And you want your portfolio to do well. And maybe going back to our earlier point, like that is, I think, maybe what causes trepidation is that it seems complex, or it seems difficult, or it seems hard to do. But It's not. It really is. Sometimes the more simple a portfolio is, the better it really is from a structure. Like if you can understand what's in your portfolio, you'll know how it's going to react to sort of different market environments. One thing that drives me crazy sometimes that when we have clients transfer over to us is getting a statement or a portfolio that has hundreds and hundreds of stocks in it.
Yeah.
And what I end up showing the client is like, you have like 200 or 300 positions or even 100 or 50 positions, and your portfolio behaves exactly like the market or maybe worse, right? And so sometimes simplicity can really be a great way to make things easier to understand, but also have better performance. But it is interesting working with athletes.
I understood completely. So great. So look, Greg Casals, thank you so much for your time. I mean, you've been incredibly open with your knowledge, your experience. We'll certainly put your contact info, a little bit of info about the Blackswift group below the video here. And certainly if anyone wants to follow up with you with questions, then they can do that directly. Send my regards to Tyler Hamilton. We've had him on the show. Great, terrific guy. And thanks again for joining us on TCL. Thanks, Greg.
Thanks, Jamie. It's been a fun being here and happy to talk anytime. And absolutely anyone that wants to reach out to us, we're happy to point them in the right direction or offer them advice. So thank you.
Perfect. Thank you, Greg. And for those of you who've been watching, if you have enjoyed this video, of course, please do give us the thumbs up. And of course, please do subscribe to the This Cycling Life YouTube channel. We'll be reaching out to you again soon with another webinar in our series for current and former professional cyclists.